Hello, I'm here today on behalf of the Women's Resource Center to talk about financial decisions during a divorce. My name is Dr. Laura Mattia, and I have also been through a divorce before. And I'm here to tell you that there is life after divorce, uh, because going through the process of a divorce can be very devastating, both emotionally as well as financially. And the decisions that you're making now through this process of going through a divorce are going to have lasting impact to you, the way you live, your overall retirement, and the just overall financial well-being of your life. So our hope is that we can help you make better decisions through this process. So, the actual content of this conversation is going to start out talking a little bit about the emotional component of divorce. We're going to move into trying to encourage you to claim your financial power, focusing on those items that you should be thinking about around your overall property, particularly, especially your marital home and also retirement assets. And then I'm going to review a couple of the pitfalls that hopefully you'll want to stay away from. And we'll talk about those pitfalls as we actually walk through this conversation. So I want to start out by just, recognizing the obvious. You are going through a process that actually is very similar to the process of grieving. You have made a commitment to an individual to stay with them the rest of your life, and for whatever reason, things haven't worked out. And it's a very sad time. I think even when you make the decision yourself, it's a difficult time and it's a stressful time because you know that the decisions you're making are very important. However, what happens actually physiologically is that our brain just isn't functioning the way we're used to it functioning. What happens when we're going through the process of grief or any level of stress is that your neocortex, your reasoning part of your brain, shuts down. And unfortunately, what's left to help govern you through these decisions are your limbic system, which is the system that governs your emotions, as well as reptilian complex, which governs your instincts. And we really want to make sure that while we're going through this process, when we are in the grieving stage, that we are not making too many decisions that are irrevocable. There are going to be decisions that you're going to have to make no matter what. But even those, when you're going through the process, you want to really think them out and be very slow and deliberate in terms of those choices. Because overall, any financial decisions that are being made in a state of any kind of emotions is never good. And so the first pitfall that we see often is that people have made choices in that emotional state. I want to encourage you, make as little choices as possible, only those choices that are absolutely necessary. Because you may be feeling a lot of these types of emotions that are listed on the screen. You might be experiencing one of them, two of them, or maybe even all of them, feeling weak, feeling forgetful, feeling guilty, overwhelmed, abandoned, lonely. And so again, these emotions are it's important to be very aware when you're feeling this way so that you can act accordingly. So I've looked at a lot of the transition academic work that's been published over time. There have been many, many studies. This particular transition curve came from a psychologist named John Fisher. He's from the UK. He put together this transition curve of any life transition that you might go through. So whether it's divorce or loss of a loved one or retirement or moving to a new home, you will have a tendency of going through this roller coaster of feeling like there's hope, to feeling like there's despair, to finally finding your way forward and feeling like there's hope again. We actually broke it down into 4 distinct stages. This initially came from work from the Financial Transition Institute, who compiled all this different academic work into 4 distinct stages. And it's very, very clear that these are the stages that you will go through, not necessarily in a linear fashion. You might spend more time in one stage versus the other stage, but you will go through this process of first starting out in an almost anticipatory stage where you think something's happening, you're not sure, your marriage is not quite right. If you are in this stage currently and you have time to prepare and start getting some of your documentation in order and thinking about what would be a graceful way of transitioning through this, that's great. Oftentimes, maybe somebody doesn't even realize that there is something wrong and until it actually hits them. And their spouse has come to them and said, I want a divorce. And so at this second stage, the grieving stage, the ending stage, it's when we actually have decided, yes, we are getting a divorce. And it's this stage in particular where our emotions are definitely at their height. And it is the grieving stage where you're grieving the loss of something that you thought you were going to have for the rest of your life. You're not just grieving the actual marriage, but you're grieving the role that you played in that marriage, how life was at that time. So there's a lot of uncertainty. There are a lot of changes. It's important to recognize again when you are in that stage so that you can protect yourself. The third stage, the passive stage or the growth stage, actually has 2 kind of subcomponents to that stage. There's the piece where you're walking into the passage growth stage and you're saying, okay, I understand what's going on. This is the reality of what I need to be doing. And so you're starting to become a lot more rational at that period of time. But near the end of that stage, hopefully you're going to start seeing that there is life after divorce and you're going to have a new feeling of optimism. And what do you want your life to look like going forward? And that can be an exciting time. And then moving into the new normal and the new reality where you start living life on your terms, the way you want to see your life. Again, being able to look at these 4 stages and get a sense of where you are at any point in time will help you in determining how you should be approaching this process. So I wanted to talk about a couple of statistics because especially some of them are really important to recognize. Some of them I just threw in there. Starting with the first one, the most common reason cited for divorce is blank. Do you know? The answer is actually a lack of commitment. But infidelity, money arguments are part of it, but that lack of commitment. And so where you got married to this individual and you once both felt that you would do anything for each other, you would die for each other, that's no longer there anymore. And it's important to understand that both from your side, but also from your spouse's side as well, because they're not necessarily looking out for you. And that's why you need to take a position where you're going to be much more insular and much more protective of yourself. When marriages end, usually some time has passed since the wedding. In fact, the average length of a marriage prior to divorce is 8 years. Couples that argue about finance at least once a week are 30% more likely to get a divorce. Divorce comes at a big cost with couples spending an average of, and this is across the country. So it includes areas that are very, very poor. And when we think about the fact that the average individual family or household doesn't even have a couple $1,000s in savings, a $7,000 expenditure on divorce can be very expensive. Now, we've seen numbers that have gone way higher than $7,000. I've seen several divorces that have really gotten extremely expensive, where we're starting to talk about almost $100,000. So, it's ideally you do want to work together and come up with solutions that benefit both of you. The last 2 are really important statistics for you to be aware of as well. 9% of women in a recent study said they were met with surprises during their divorce. And the answer is 60%. And important for you to brace and know that that is something that may be coming. You may find out things that you had no idea about. And in a study, blank percent of divorced women said they found secret accounts after their marriage had ended. And the answer to that is 77%. So again, it's important to recognize that in a lot of divorces, money does go missing, and you want to make sure that you're paying attention to what's going on. So the first thing that we want to do is encourage you to really understand that you're in charge. We want to empower you, to encourage you to claim your financial power and understand your options and the consequences of each of the options that you choose. And we start out by talking about financial property. And financial property are just the assets that you own. They are everything from household furnishings to cars to savings to your family home, retirement accounts, businesses, and even other maybe investment property that you might own. We're going to focus a little bit more on the family home and pensions because that's important. But you need to understand where all of your property is and what it's currently being valued. A lot of folks don't even know the value of their property, and it's important to understand that. And then, I mentioned that 77% of women find these missing accounts after they have finalized their divorce. If you suspect that there are hidden assets, it's important to understand how they might actually be, how somebody might try to hide them from you. The first is that the person might deny that the asset even existed. The second is that they might transfer it to a third party, a child, a parent, or maybe even a girlfriend. The person might, and I've seen this one a lot, they might say the asset was lost or dissipated somehow. Oh, we had those financial assets, but they were on the market and the market declined last year and we lost all of it in the market. And then also the person creates some false debt. So even though the asset does exist, they've created this debt against that asset. And so you have to kind of flush through this and really understand what's going on. The best way, if you do suspect there are hidden assets, and you don't want to necessarily jump to hiring a forensic accountant because they can be expensive, is to do some of your own work, at least preliminary work. And the best document to start with is your tax return. Ideally, you want to look at the past 5-year tax returns, or at least the past 2-year tax returns. And you want to start out with the overall first schedule, which is the 1040, which you can look at as almost a table of contents. There are numbers on that document that come from other schedules within your tax return package that you can take a look at on a very high level and ask yourself, does this number make sense? There are then 5 schedules that I want you to spend a special attention to. The first is Schedule A, which is your itemized deductions. Now, in these current days, people are not itemizing as much as they used to because the standard deduction has been increased. But if you have itemized, you can look at this statement and it will tell you all of your current mortgages, all of the property tax against any property that you own. You might look at that because you might actually find that there's been another piece of property that was actually purchased and is on this document and you were not aware of that. It also will list things such as charitable deductions and other things on this document. So you want to go through and just put on your 5-year-old child hat and say, okay, I need to know why, what, when, all the questions. Just keep asking questions. This is not the time to be so proud as to not ask questions. You need to understand what these numbers represent. The second schedule, Schedule B, is all of the dividends and interests that have come off of your financial assets. So if you go through there and you see that dividends are coming from a Vanguard account or Fidelity account, and you didn't even think that you owned an account like that, that should send a red flag up, and you should start asking more questions about what that is. Schedule C is the business income. And if somebody is a sole operating, a sole proprietor, or a partner in a firm where they get K1s, their information gets posted on this Schedule C. And this lists out the overall revenue and all the expenses associated with that business. And you want to go through that and see, ask for the supporting schedules that actually demonstrate that those were true expenses against the business. If in fact you are getting audited, you would need to produce those supporting documents. And so they should exist. And so anybody that tries to deny that they exist, that's a big problem. You want to see those. And don't forget, there is an expense that isn't real, and that is called depreciation. Depreciation is a paper expense that is used to arrive at a final net profit number that will be taxed, but it's not the actual cash amount that is being driven by that business. And so you need to add the depreciation back in order to derive the actual cash that's being produced by that business. Schedule D is capital gains and losses. Again, that has to do with any of your investment assets. And so if you see gains or losses from something that you weren't aware of, you need to follow up on that. And Schedule E is the supplemental income and losses, which might be something, for example, royalties. Maybe your spouse is getting royalties from a past book that they authored or something else, and also rental income. So something that might be going on there. So you want to go through all of those schedules with a fairly fine-tooth comb and understand what the numbers represent, because that is where you may identify what's actually going on there. Again, I talked about the fact that you need to understand your assets, but I really want you to start listing them down and what you think the values of those assets are. So cash, and by the way, maybe you keep a lot of cash in the house, but identifying where that cash is. Your checking accounts, also a great place for you to look for hidden assets or hidden something that might not seem right, by going through that checking account and looking at who those checks are being written to and for what amounts. Really important. You want to look at the children's bank accounts, retirement accounts. Make sure that you look at all the retirement accounts, even from past employers. There might be a 401k or 403b that's associated with a past employer. You want to identify that. Any kind of other brokerage accounts, non-retirement investment accounts, real estate, not just your current house, but if there's any other property out there. And then what other assets are associated with your spouse's employer? Were there any incentive plans, stock options, deferred pay that might have been put aside in order to hide them, that you should be aware? And again, knowing what the value is of all these assets is really important. And then also knowing your debt, your liabilities. How much of a mortgage do you have? How about auto loan, credit card debt, etc.? I want to mention that mortgage and ownership of the property are two separate things. So while you may decide that your spouse is going to take the house and you file a quit claim deed so that your name is no longer on the ownership of that house, you also need to make sure that your name comes off of the mortgage. In fact, you need to make sure that your name comes off of all joint owned debt. You don't want your name on that. If your name remains on that and something happens to your spouse, you are going to be liable. The banks and the credit card companies, they don't care that you got a divorce. They see your name on it and they want to get paid. And so you need to make sure that you try to dissolve that debt as soon as possible. Another pitfall and mistake that we often see with individuals is that they don't do that. Okay, so after you actually define all your assets and your liabilities, you want to get the supporting documents to validate that. So you want to get all of the investment statements, the employer-sponsored statements, anything else that you need to support this work. And a matter of fact, you want to get a copy of the last mortgage closing paperwork. When you got that mortgage, even if it was 7 years ago, try to get a hold of that and see what was listed on that closing paperwork, because that's another place where you might see assets that you were unaware of or that you forgot about that you want to actually ask some questions about. But these documents should help you in terms of valuations. Now, there is a document that you're required to sign throughout the divorce process called a mandatory disclosure document. A lot of people sign that document even though they haven't seen all this paperwork. I highly recommend that you don't sign that document, that you've seen that documentation, unless you've actually seen it. Make sure that you've asked for it, or you've explored ways of finding that documentation, which is one of the reasons why, if you are in a preparatory stage, you might get more cooperation to get a hold of that documentation than you might get once the divorce process is actually started, especially if attorneys and it becomes a litigious type of situation. You want to make sure that you get that documentation. So we know what assets are outstanding, but the next question is, well, what assets are actually my separate property, my spouse's separate property, or marital property? Because that it matters. If property that is my separate property, I get to keep without splitting it. Marital property, on the other hand, we have to split. So I have a couple examples here. The first example is Julie and Tom are getting a divorce, but Julie had in her bank account had saved $1,000 way before they ever even got married. And the question is, if she just left it there and never commingled it with Tom, and that $1,000 actually made some passive income from there, would she have to split it? And generally, the answer to that is no. I mean, it can be argued at some points, and I'll show you an instance where it's argued, but usually this would just be her property. So knowing that this is her separate property is really important before she starts sharing that. Here's a situation that's a little bit different, where Karen, prior to the marriage, had a house. And so she had a house, she got married to Bill, and now they're getting divorced. They've been living in the house. Initially, when she got married, at that point in time, her house was valued at $500,000, and she had $230,000 of equity in that house. Now, the house at the time of divorce is now valued, it's appreciated, and they've paid down their mortgage to a certain extent, and the overall equity, it has increased. The way this would work is that she would have the $230,000 of premarital asset, and the additional $170,000, which came from $20,000 of paying down the mortgage, and $150,000 of appreciated asset, will be split between the two of them. And the argument there is that they both funded the pay down of the mortgage and maintained the house throughout their marriage. And so it does make sense that that should be split between both of them. A couple of other little vignettes here. Kathleen's getting divorced from Sam, and she had firstly inherited $20,000 from her grandmother. and she put it in a separate account and she did not commingle it with Sam, that money is hers. And so she doesn't have to split that money. How about the $30,000 8-carat diamond ring that she received as a gift from Sam? This, some people have some trouble with, but the truth is that if she tries to say, no, 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 that was a gift, Sam's probably going to turn around and say, what are you, crazy? I would not spend that on a gift. That was an investment. And so most likely that would be considered marital property. And then what about if Kathleen put money aside, $1,000 aside every month from her paycheck during the marriage? Is that her money? The answer to that is no, it's marital property because she used marital assets, regardless of the fact that it came from her paycheck. They were considered marital assets because she made that money during the marriage. And so that has to be split with Sam. What about career assets? Often overlooked. And it's important that you consider this. If you are in a marriage that you gave up your career, maybe you stopped going to school, maybe you've been following your spouse around from state to state, country to country, trying to invest in his career because his career had more opportunity. Those assets of his future earnings, we often call that the present value of future earnings. Those assets should be split between both of you. And so it's important to think about how you've approached your marriage and if you've really invested in one spouse or the other spouse. It would go the same for you as well. If you were the person that he invested all of his time and effort to helping you with your career, then you would be expected to split it also. And that's why when we talk about the division of marital property and people say, oh, it needs to be equal, it's not necessarily equal. When they say equitable, that does not mean equal. It means fair. And so it's really good for you to understand that and why maybe career assets should be introduced into the equation. Why, if one spouse is taking care of the children, the other is not, that needs to be factored into the equation. Your ages need to be factored in. There are a lot of other pieces that need to be considered. So just taking your overall balance sheet of your assets and splitting it in half is probably not the right way to do it. Now, I want to talk a little bit about the marital home. This is one of the areas that we do see women getting particularly emotional about. Oftentimes, they will look at the house as being, first of all, a piece of security that they feel comfortable. They have a roof over their head and they understand this house. They feel comfortable in this house and they want to maintain it. They also might be nostalgic about the house because this is where they raised their children and had good experiences in. And I want to caution you that that's not always the right answer. And I have a couple of different things that you could do with the house. The first thing you could do is sell it. And honestly, that is probably the best solution. Just sell it and move on. You can split it much more easily than the other two options. The second option is you could buy it out from your spouse, but valuation oftentimes becomes a big issue, especially in environments where the marketplace has been vacillating a lot, and it's very difficult, especially in this current environment. And I'm talking about 2023 right now, where interest rates keep changing and real estate seems to be going through a lot of changes right now. You might want to get a third-party appraiser to come in and actually value the house. Once you value the house, it's only part of the equation. The next question is, should you include in the value of the house or put against it expenses if you should sell the house? And the biggest expenses that you want to consider are the selling costs associated with selling the house and also the taxes associated with selling the house. And so those two questions really need to be addressed. Oftentimes they're not addressed. And the third choice is owning the home together for a period of time. And we often see this if there are children maybe that are still in high school, they have a couple more years to finish out the high school, and it's decided that one spouse will remain in the household, and later on you'll sell it and both people will walk away with the proceeds. If in fact you do wind up owning the house together, it's important to remember that the property settlement that you do today will affect how that split occurs years down the road. And so you need to think about that. We often recommend that it be a percentage of equity. And I'll just give you a quick example of why that's important. But you both you both participate in any appreciation of the house or depreciation, and that can protect you. And again, you can transfer the home by using a quick claim deed fairly easily, but don't forget to refinance the mortgage. Very important. Usually in a joint ownership situation, the way expenses are split, the major expenses like the mortgage or significant repairs to maintain the value of the property or even appreciate the value of the property are split evenly between both parties. But the incidental expenses like the property taxes, the insurance, and other minor repairs are usually handled by the resident owner of the house. So you can figure out how to split that so that it makes sense. But this is an example of what happened to Kathy and Scott. They owned a home in 2007 worth $800,000, and they agreed. They had no mortgage. They agreed that they were just going to split even Steven $400,000 each of the house when their son was done with high school, and he was to be graduating in 2011. Sounded like it made a lot of sense. Kathy even agreed that because Scott was waiting on the money that he was going to get from the house, that she would pay him 3% interest, just so that he felt like he was getting something from the value of the house. Well, 2011 rolled in and the value of the house actually decreased. And what happened was Kathy had to spend not just the $400,000 that she had to give to Scott, but she also had to give him the $55,000 of interest, which left her with $45,000. Not such a great story there. What they could have done is they could have done what Janet and Kevin did, which they said, no, at the time, we're going to split it 50-50, and whether it appreciates or whether it depreciates, we're both going to share in whatever it turns out to be. And therefore, they would both walk away with some value from the house and a fair split. So not thinking about that overall housing decision, what should you do? Should you sell it? Should you own it jointly? Should you try to buy out your spouse? And then how is that going to actually work is really important. And this is another example of why it's so important. Now here we have Sarah and David own a couple of different pieces of property. They own a house, which has a mortgage on it and has a fairly low cost basis to it. They have a 401k. It doesn't matter whose name it's in. It's marital property. It happened while they were married, and they have a CD. And David says to Sarah, well, why don't we do this? You want to stay in the house. You stay in the house. This worth $150,000, and I'll take the other two assets, and everything's going to be fair. We'll both have $150,000. Well, that was fine until a couple years after the marriage, where Sarah was given a promotion in another state and had to sell her house. And so she sold her house, still valued at $700,000, but she had to pay selling costs. The commission 6% of $700,000 is $45,000. And she also had to pay taxes. And it's important to know that individuals who are married get a $500,000 exclusion to their capital gains. Single individuals only get $250,000. So she was able to exclude $250,000 of the $470,000 capital gain, but that still produced $44,000 in taxes. And to top it off, she needed to pay for moving costs, storage, and other financing costs, which wound up leaving her with $55,000. So while she thought she had $150,000, which was well past the 20% down payment she needed to qualify for a mortgage to buy a house of similar value, another $700,000 in her new state that she was moving to. She only had $55,000, which only qualified her for, I want to say something like $255,000 worth of home. And so that came as a rude surprise to her. She didn't really think that all through. And it could have been set up much better if they had actually talked about what if she needed to move out of the house fairly shortly after the divorce. So housing is one thing that's usually a fairly large choice that you need to make. The second is around retirement plans. And there's really two kinds of retirement plans that you want to consider. They're the retirement plans that are qualified under ERISA, and they come from benefits through an employer, like a 401k or a 403b, which are considered defined contribution plans. They're defined contribution plans because you put money into those plans and you make decisions on how they're going to be invested and how they're going to grow, and you will benefit from whatever the balance is at the end of that period of time. You might have an employer match, which incentivizes you even more to contribute to that 401k, but it's really more, the onus is on you to properly invest it and make sure that you have money at retirement. Defined benefit plans are a little bit different because the employer puts money aside for you. The employer makes decisions on how that money is going to be invested because they have a specific objective of exactly how much they're going to pay out to you at the point of retirement. So they're a little bit different, but both of those kinds of plans are governed under ERISA. And if in fact there are these plans that you need to split, you will need something called a Qualified Domestic Relations Order, or a quadro, which are fairly sophisticated, complicated documents that you need to have somebody that's an expert help you use. There are also some other kinds of tax advantaged accounts, but they're outside of the employer. They're not through your actual employment. And those are things like traditional IRA, a Roth IRA, or a SEP or a simple, which are plans that sole proprietors might use. But these are retirement accounts that are not protected under ERISA, and therefore all you will need to divide those assets is you'll need a court order. So one, you need the quadro, and the other, you need a court order. One of the things that we did for a client fairly recently was they had a significant 401k. They were going through a divorce process, and we started going down the road of getting an expert to do a quadro. And then all of a sudden the light bulb went on, and I said, why don't you just roll that over into a traditional IRA until after the divorce, and then we'll split it based upon the court order. It saved everybody a lot of time and anxiety over whether this quadro was being executed correctly. The things that you need to think about with these quadros is that they need to be very, very specific. A couple other things that I want you to consider, however, is that if you are under 59 and a half, Normally, you cannot take money out of any of these plans, whether it's a 401k or an IRA. You cannot take it out without incurring a 10% penalty. However, there is a special IRS provision. It's called 72T2C that allows you to take money out. You still have to pay taxes, but you don't get hit with the penalty if, in fact, you need that money. I want to encourage you not to take it out because that money is really for retirement. But if you need to, and it is a matter of whether you have enough money to pay your living expenses and your bills, then there is a provision for you. Want to also just mention the defined benefit plan. Usually it's probably better to determine the value of that plan and then offset it with other assets. So when the person maybe that owns the defined benefit will just keep it and the other spouse will get other assets. The process in valuing the defined benefit plan is somewhat complicated. There's several formulas. Different states use different formulas, but they are rather complicated to calculate. But not splitting these assets correctly can cause a lot of problems. And especially in the realm of the ERISA assets, where you need to use the quadro. And the most important thing for you to know about a quadro is that it cannot override what a plan in the employer, let me back up. When the employer establishes a defined contribution plan like a 401k or 403b, or establishes a defined benefit plan, they are required to put together a plan document on how those 401ks, those defined benefit plans, those defined contribution plans work. They're very, very specific. The quadro cannot override that plan. So the quadro says that the assets are going to be split in a certain way that's not consistent with the plan. You are not going to get those assets. So it's very, very important once the quadro is executed before the divorce is finalized, that you take that quadro to the plan administrator and find out from the plan administrator if, in fact, the assets can be split the way the quadro is defining it. Really, really important. If you don't do it, chances are that you may not ever see those assets. You also want to make sure a couple of other things that the quadro does. You want to make sure that there are survivor benefit provisions. If, in fact, your spouse passes before those benefits are made available to you, you want to make sure that it states what's going to happen to make you whole. And the other thing that you want to do is you want to make sure that if there are any kind of early retirement incentives, that you are also considered in that aspect as well. But not having the quadro, splitting the property properly is a big mistake that we see happen often. So please try to avoid that by taking the precautions and making sure that it's all agreed upon by all parties prior to the divorce being finalized. Just quick mention about Social Security. If in fact you were married to your spouse for 10 years, you are entitled to spousal benefits, either half of his benefit, or if he's no longer alive, the full benefit. Your benefit might be more than his benefit, but you are entitled to it. And there are ways of executing it so that you might be able to take his benefit first and allow your benefit to grow and continue to become a more healthy benefit, even up to the age of 70, and then switch over to take your benefit. So you want to make sure that you explore that option as well. So those decisions, really, really important. Wanted to go over one case study that kind of brings a lot of this together. on what has happened, what could possibly happen, and then how you might even want to get a financial advisor who's worked with folks going through a divorce involved to help you. This situation with Jenny and Jason, they are young. They're 42 and 43. They have 2 young children. And then there's a fact pattern listed here where it talks about the fact that they decide that Jason's going to pay child support. It shows his income, what her income will be in a couple of years when she finally goes back to work. The value of his practice. He has a veterinary practice, the equity in their current home, and the equity in rental property that they own. And so they decide that they're going to split these assets Steven, equally, maybe not fairly, equally. And unfortunately, Jenny, because she's very intimidated, she's not working, she feels like Jason's the one that's working, she doesn't feel comfortable to push back and say, is this really fair? So she doesn't ask the right questions. And so it looks fair right now by just looking at all of these individual splits and the fact that they both have $281,000. But I'm going to show you that maybe it's not fair. And so she allowed it to go too quickly. She didn't ask questions. She almost felt like she was being pushed into it. And that is a big pitfall, a big mistake. So one of the things that a financial advisor will do if you get them involved, where an attorney might not, they would look at the 281,000 split and say, it looks fair to me. The financial person will say, well, okay, let's extrapolate this information based upon everything that we know, based upon what we know about your spending needs and how you're actually going to be making income and so forth. Is your net worth going to grow? And the first caution is that while we see Jason's net worth continuing to grow, Jenny's net worth is not going to grow. And it's not the end of the world, because at least it's her net worth does maintain around $300,000. So it doesn't go up, but it doesn't go down either. So maybe I would not be as concerned about that. However, I'd also want to take a look at her working capital projections of the overall cash that she has to spend on living. And when we did these projections, we found that by age 48, within no time at all, she had run out of cash completely and did not have the right working capital, primarily because she was house poor. If you noticed how the house was on her side of the balance sheet, you can't put a window on the kitchen table to eat. So they had this house, but they didn't have enough money to buy food and those types of things. So this case, I would already say this is not fair, and I would be concerned about that if I was working with a couple that was getting divorced. However, it got much worse, because what really happened was that right after the divorce, Jason got remarried to his girlfriend, Holly. And 2 years later, he got into a car accident and died. And so there were a couple things that didn't materialize the way they were supposed to. And I'm going to kind of go through my list here. First of all, Jenny had been spending more than she makes. So she now has $500 in her checking account, and the money market's completely gone. Don't forget, Jason's dead. They didn't have protection, adequate protection to cover that child support that he was supposed to be giving her. So that dried up, no more child support. And so she had very little to live off of. She had not taken any money out of the IRA, so it's still there, $17,000. But unfortunately, that quadro, they did not file it properly. And as a result, the second wife became the beneficiary. So Holly actually got that amount that was really entitled, that 401k that was entitled for Jenny. Jason's pension now valued at $35,000. I think that's the same as it was. Jenny had to withdraw the assets from the variable annuity in order to pay for various things, and she had to pay a surrender charge and taxes. So she ended up with $26,000. What she could have done actually with that variable annuity is she could have used that to help pay for the insurance, because that insurance could have covered the child support that Jason was supposed to be paying. So that was a big miss. Jason's value is still worth $200,000. The equity in their marital home and the rental home remained the same, so 90 and 60. Now, prior to his death, Jason had been making regular payments on the visa and the car loan, but the car loan was solely in his name, so that stayed in his column. But the visa, because Jenny never took her name off of it, and now moved into her column. And unfortunately, they got a notice from the IRS after Jason's passing saying that their tax return was not filed properly, and so they owed $43,612. So now Jenny only has $92,000, not $281,000, and Holly has the estate, the $379,000. So it's very skewed, and unfortunately, that affected. One of the pitfalls I wanted to mention that I forgot was the idea that Jenny should have put away early on cash in a separate account earmarked for this entire process so that she was covered. It's good to have a good amount of emergency savings. And oftentimes people say, oh, well, it's not making enough return. That's okay. You need that money to live off of, so you need to put that aside. But when I took those numbers and we projected out forward what their net worth was going to look like, Jenny, instead of having a net worth of somewhere in the neighborhood of $300,000 going out, she immediately plummeted down, and within a couple of years had nothing, no value at all. I mean, yes, she had that equity in the house, but she had so much liabilities, so much debt put against it that washed out any net worth. And then supporting that those future payments, those future child supportments with a good life insurance policy was a big mess on their part. And working capital, here you see that she's completely in the red. I mean, not even just hovering in the zero. I don't know what she does at this point. She needs money from family and friends and other sources, because clearly this is not going to work if you have a negative working capital. You spend way, way more than you ever would have coming in. So these kinds of projections are really important. Oftentimes what we do with the overall analysis is we want to really understand what is required to live off of in terms of income and spending, and the costs associated with raising the children and taking them to hockey camp and all those other things. Really, really important to get that clear and understood. And then what we do is we make projections into the future, usually at least a 20-year period of time. And we look at best case and worst case. We do 1,000 trials of what if everything works out really well, the best case actually materializes, or what if everything works out poorly? What is the worst case? And we get that kind of band of best case, worst case. We can then make a decision if in fact over 800 of the 1,000 trials are positive. We say that you have an 80%, or in this case, an 83% probability of success. We would say that that's pretty good. And so we'd be happy with that. If it said something like a 50% probability of success or a 30% probability of success, we would say, no, that's not a good property settlement. We need to go back to the drawing board and reconfigure this. So just something to think about, that whole not just how does this look on paper today, but how is it going to fold out over the next 20 years? And so I went through some of these pitfalls with you as we were going along. I I would recommend that you maybe take a note of these pitfalls. Maybe you want to take a picture of this and uh, keep it in the back of your head in terms of the different things you want to be considering as you're going through this process. Because I really wish you the best. I want to reiterate, there is life after divorce. You're going to be fine and you're going to be happy, but you want to make sure that you make the optimum decisions for yourself. And if you have children and other family members that are dependent upon you, you want to make sure that it's been well thought out and you don't want to rush through it, especially if you're finding yourself stuck in that grieving stage where you're just not able to make rational choices. Think about it and make sure that you are making the right decision. Get somebody involved, whether it's a financial advisor, whether it's your attorney. Hopefully, if it's just your attorney, they have some financial acumen, or even other family members or friends, so that you are making the best decision. And just want to throw up my contact information here for you. If in fact, yeah, I do a lot of volunteer work for the Women's Resource Center, offering pro bono financial advice for ladies. If in fact there's a question that you have from this conversation that you want to contact me on, as long as it's a quick conversation, I'm happy to do that at no cost. I mean, if you want me to start doing project types of things where I'm now getting much more involved, it's much more time consuming, maybe we would have to discuss you hiring me. But in most cases, it's if it's just a quick question, I'm happy to answer. So again, I wish you the best, and I make sure you get all your resources and get the support that you need, and best wishes to you. Thank you so much. Bye.